Bim. Hi folks, Nick Masunda here, fifth video, and I'm going to be talking about individually versus super owned life insurance in this video and the pros and cons of each. This is actually a debate that played out regularly in the office between different advisors when I was a life insurance advisor, and their positions on whether individually owned is better than super owned were quite split, reasonably split. So I'll break down the pros and cons for you guys and you can decide what you think is best. Firstly, I'm going to talk about the different insurance types of life insurance that are available and what options they offer in Australia. And then I'll just talk about the pros and cons of individually owned policies and then the pros and cons of super owned policies. So there's three types of life insurance that you can get in Australia. Direct insurance policies, retail insurance policies, and superannuation, and group policies, which are typically offered by superannuation funds. So with direct policies, which you would buy directly from an insurer, they're usually pretty limited and you can only have individual owned structure with that. With retail policies, which are typically offered by insurance advisors and financial advisors, you could have individually owned structure, but you can also have superannuation owned structure. They're quite flexible, there's different structures available. With the superannuation offered group policies, that superannuation fund is going to be the owner of the policy. They're quite limited. So they're the options. Now for individually owned policies, the positives, the pros. First one is that it's pretty simple. You can nominate any beneficiary you like at any proportion. Okay, so that's when you've got outside of super individually owned policies. The second benefit is that the benefit payment, the payout of the life insurance policy is going to be tax-free for the beneficiaries. Okay, there's a little bit of confusion I found online about this, but if you're the individual owner of your policy, which is going to be the case the vast majority of the time, unless you specifically ask for a different ownership structure, then you can nominate any beneficiary, they're going to get the benefit paid tax-free. Okay? So to be clear, third benefit with, or positive with individually owned life insurance policies is that you get a few extra bells and whistles in terms of benefits. So but the fundamental benefits of the life insurance policy is that it's going to pay out a lump sum if you pass away and if you're diagnosed with a terminal illness. That's generally the way the policies pay out. But you can have these additional benefits like a funeral advancement benefit where they pay a portion earlier than the balance of your full benefit to account for funeral costs, as the name suggests. There's other things like child trauma benefits that can be tacked onto life insurance policies, financial planning benefits, these things that insurers include to sort of differentiate themselves are generally not included if your policy is owned by a super fund. Okay, so they're the positives for individually owned life insurance policies. The negatives, the downside, there's not many, but one of them is a big one. Okay, pretty compelling one. So first of all, the downside is that you have to pay straight out of your pocket, so it can impact your cash flow. Okay, so that's generally considered a bad thing. And then the second downside is that the premiums are paid with after-tax dollars. Okay, all right. The premiums for individually owned life insurance are not tax deductible. All right. Now, conversely, these negatives for individually owned life insurance are positives for super owned life insurance. So the first benefit or positive for super owned life insurance is that there's options from a cash flow point of view. Okay, you can because obviously the premiums are getting paid. Well, the premiums are getting paid from your super fund. Okay, so it's not impacting your individual cash flow. The downside to that is obviously that it's reducing your retirement savings, but you've got the option of making additional contributions to your fund to offset that if you prefer. So you've got the flexibility there. Obviously, things like your concessional contributions cap have to be taken into consideration, but I'm not going to get into the nitty-gritty of that. And second benefit of super-owned policies is that the premiums are tax deductible to the super fund. So if someone is a proponent of super-owned life insurance, then they're definitely going to be citing this benefit, right? The tax deductibility of the premiums to the super fund. Okay, so that's probably the most compelling benefit of super-owned life insurance. There's a few downsides to super-owned life insurance. Okay, so the first one is going to be that there's limitations on who you can nominate. You can only nominate CIS dependents. Okay, and CIS is an acronym for Superannuation Industry Supervision Act. So it's the legislation that sort of dictates what you can and can't do with super. And yeah, there's only certain people that are considered CIS dependents. Your spouse, your children are a couple of examples. So because your spouse and your children can be listed, particularly your spouse, it's usually not a big deal, or it can be worked with. Okay, this limitation. The second downside or limitation is from a tax perspective. On the benefit, when the benefit is paid if someone passes away, if the beneficiary is not a tax dependent, then they'll be tax charged. Okay, 30% plus the Medicare levy. Okay, now that is obviously substantial. So the question probably in your mind is, well, who's considered a tax dependent, right? So this would be your spouse, your children if they're under the age of 18, your ex-spouse as well, funnily enough, are a few examples of tax dependents. So if someone did want to list their children and their children were adults as beneficiaries and their policy was owned by super, they're generally going to make changes and avoid that. Maybe just make their spouse their beneficiary, and then they can distribute the funds in a tax effective way. Something to consider. The fourth, oh no, we're up to three, aren't we? Okay. Third downside for super-owned policies is that the policies are more basic, conversely, compared to your individually owned policies. You don't get those secondary benefits like your funeral advancement, child trauma cover, etc. Okay, the policies are usually more stripped down and basic. Still, the fundamental benefits are there, right? If you pass away, there's a benefit paid out. If you're diagnosed with a terminal illness, and given either 12 or 24 months left to live, depending on the insurer, typically, then you can claim, and there'll be or your beneficiaries can claim. Okay. Fourth downside for super-owned policies, or level of complexity, let's say, is that when you nominate your beneficiaries, you can have binding and non-binding beneficiaries. Okay, if you have binding beneficiaries, generally the super fund has to pay out the benefit to who you list, similar to the individually owned policies. Okay, the trustee of the super fund that owns your policy has to pay those beneficiaries, and they will, assuming that it's a valid, CIS dependent, etc. With non-binding beneficiaries, the trustee still has their discretion. They can change who you've nominated and what proportions. Okay, so this is just something I wanted to mention so that people are aware of it. With binding beneficiaries, okay, so having just described the differences, most people are fans of binding beneficiaries. Binding beneficiaries often will lapse though, and it's usually 3 years when they would lapse, and then you'd have to resubmit them. Some super funds offer non-lapsing binding beneficiaries if that's available. That has its pros and cons, of course, as well, but generally favourable. So that's mainly it as far as the pros and cons. So I guess in summary, guys, individually owned life insurance policies are very simple, very straightforward, and very safe. And then you've got your superannuation owned policies, which are more complex, but have potentially significant tax benefits if done correctly. Definitely worth getting some advice on this sort of thing if need be, because it can get pretty complicated, particularly with the super owned life insurance structures. So yeah, that's pretty much it, guys. Thanks for watching.